Hey everyone, and thank you for joining us today. We appreciate you taking the time to be here. Our goal with these quarterly webinars is to walk you through what's been happening in the markets, explain what's driving recent moves, and help connect those headlines back to your long-term financial plan and portfolio. Today, we're going to be walking through 10 market and economic themes for Q1 of 26, which we are currently in. We'll be recapping the fourth quarter as well. But these are market and economic themes we believe are most likely to shape markets in the months ahead, probably throughout the year. We're not here to predict short-term moves at all, but to provide some context around risks, opportunities, and what we're watching as we manage portfolios going into this year. So let's start with the market recap from last quarter. So the fourth quarter was anything but quiet. It began with a record-long government shutdown, renewed trade tensions and concerns around credit quality, all of which created early volatility. At the same time, the Fed cut rates twice and ultimately followed through with a third cut in December. Economic data sent mixed signals, with unemployment rising, but GDP growth rebounding sharply. And despite all of that, strong AI-related earnings and easier monetary policy helped push the S&P 500 to the finish line near an all-time high. So very strong into the quarter. Corporate earnings. Strong growth is supporting high valuations for the time being, at least. So valuations do remain elevated. The S&P 500 trading around 22 times forward earnings, near historic highs. At the same time, earnings growth has been strong with multiple consecutive quarters of double-digit growth. That earnings strength, especially from large AI-focused companies, has helped justify today's higher valuations. Going forward, earnings growth will be increasingly important in determining whether markets can continue to move higher with valuations stretched. Here we're looking at fewer S&P 500 stocks outperforming the index. This has been a trend here, so it's been an important trend, and it's been this narrow market leadership. Fewer stocks are outperforming the index, largely because a small group of mega cap tech companies has driven a disproportionate share of returns. While this has supported index performance, it also means the market has become more concentrated and dependent on just a handful of companies to keep delivering strong results. However, I will say that thus far in January of 26, that is starting to broaden out, starting to see more participation from various sectors. The tech industry is actually pulled back a bit in terms of its contribution to returns. So that is beginning to broaden. You're seeing outperformance from small cap stocks, for example. So we are seeing a broadening of that leadership, which is a good thing. And leading into that, a good segue into this is, here we're looking at international markets. We're seeing the biggest relative outperformance since 2009. A major shift in 2025 was the strong outperformance of international stocks relative to U.S. stocks. After more than about a decade of lagging performance, international markets outperformed by 10%, driven by attractive valuations, fiscal spending overseas, and shifts in trade policy that weighed on the U.S. dollar. 1 year doesn't make a trend, but it raises the possibility of a more balanced global market leadership going forward. Valuation Monitor, asset class pricing at extremes. When we step back and look across asset classes, we see prices near historic highs. Tight credit spreads, relatively low volatility. Stocks, commodities, gold and silver, for example, and even international markets are all trading near the top of their 20-year ranges. It doesn't mean this is signaling some imminent downturn at all. We all know these things can continue for a prolonged period of time, but it does mean expectations are high and future returns are likely to depend more on fundamentals than momentum. GDP growth rebounded as trade uncertainty eased. Economic growth in 2025 was very volatile, largely due to trade-related distortions. After a weak first quarter, GDP rebounded strongly in the second and third quarters, supported by consumer spending, AI-related investment, and improving trade flows. When we look past those trade swings, though, underlying growth appears relatively stable, supporting the idea that the economy may be heading toward a soft landing. Here we turn our attention to the labor market. Job growth is slowing, but layoffs remain low. The labor market continues to cool. Job growth has slowed significantly. Hiring has softened, and unemployment has risen to about 4.6%. At the same time, layoffs remain relatively low, creating what many economists describe as this low hire, low fire environment. It's a gradual softening. It's a key reason the Fed began cutting rates in the second half of last year and will most likely remain a major focus in 2026. Interest rates, effective mortgage rates, they're rising. Even though mortgage rates have come down from their peak, the effective rate households are paying continues to rise. That's because older, lower rate mortgages are slowly being replaced with higher rate loans. Makes sense. This highlights how monetary policy works with a lag and why consumers may continue to feel the effects of higher rates even as the Fed cuts interest rates. Let's take a long-term perspective here. As always, recent performance has been extraordinary. We've come through 3 years now of just absolute, bar the door returns. Really historic in a lot of ways. Looking at the market over longer periods, the past decade has delivered unusually strong returns, driven by low interest rates, rapid technological innovation, AI obviously is part of that, and significant stimulus. History shows that periods like this often raise expectations and leave less room for positive surprises. That doesn't mean markets are poised to fall, but it does suggest future returns may be more modest and more dependent on fundamentals. I think even at a high point here, I'll pull up this chart while we're talking about it. We had an annualized rate at one of the peaks here of almost 13% over a rolling 10-year period. Now that's high. There's rarely been a time as high as that other than, obviously the 1990s kind of blew the doors off. And then, we had periods obviously leading up to the 1929 crash and things of that nature. But it's been elevated, for a while in terms of returns. So looking ahead, we got key themes for the next 6 months, which we've been talking about. We're really focused on these three kind of broad themes: the true state of the economy as delayed data is released, the sustainability and financing of massive AI infrastructure spending, and whether lower rates help the housing market continue to fall. How these develop will play an important role in shaping markets in the first half of 2026 and probably beyond. But that's what we'll be watching, and I hope this helped in terms of where we see things, how we're looking at the markets and the economy, and we appreciate you spending some time with us today. Our focus always remains on staying disciplined, managing risk, and keeping portfolios aligned with long-term goals despite short-term uncertainty. For clients, please contact us. Reach out anytime with any questions. We're always here for you. And for those new to us, we'd welcome the opportunity to connect and discuss how we might help with your financial planning. Thanks, guys, and we'll talk soon.